Your Money, brought to you by the Welch Group.
Okay, so in today's volatile market environment, many investors are turning to money market mutual funds as a reliable investment option. However, while they are appealing in times of high interest rates, they come with drawbacks over the longer term. Here's our Jonathan Skinner with financial expert Marshall Clay from the Welch Group to discuss the pros and cons.
Well, during the times of our economy right now, a lot of people are looking at money market mutual funds as a potential option for investment. And that's why we're talking here today with Marshall Clay from the Welch Group about some of the pros and cons with these. Marshall, what sort of can you tell us?
Yeah, so for the last couple of years, the money market mutual funds have been a great thing for investors, right? They're very stable. They don't really move all that much, and they've actually been paying a relatively high yield as opposed to what they were paying maybe like 5 to 10 years ago. So investors have received somewhere between 4 or 5.5% over the last couple of years. And so the fact that they can get that relatively higher yield in a kind of a volatile environment has been very appealing. You know, these funds are very liquid, so they're very safe, so you can sell these funds and actually get your cash back, as opposed to what our viewers may be familiar with CDs, things like that. They're a little bit more illiquid, right? With a CD, you actually have a contractual obligation with your bank, and if you renege on that, you'll actually claw some of those dollars back. So they've been a great option for folks that want a little extra yield but want that ease of liquidity. Now, the cons are coming now, where there's a lot of pressure on the Federal Reserve, which controls short-term rates and really kind of controls the yields that are being paid on these money markets. There's a lot of political pressure on the Federal Reserve to actually cut short-term rates. Inflation is still relatively a problem, so there's kind of these cross currents right now that make these funds a little bit not riskier, but not as advantageous as they have been. And so I encourage our viewers to maybe look towards, maybe some longer duration bonds, not long duration bonds, but maybe like some 1 to 3 year bonds that can lock in these higher yields that we're receiving right now and not be subject to maybe these money market funds that you'll wake up one day and they're no longer paying 4%. Your bank has moved them from 4.5%, maybe down to 3.5%. The brokerage firms are moving their funds from maybe 4 down to 3%. And remember, this is pre-tax. This is before you paid any tax. And so if we're still looking at inflation between 2 and 3%, right, and you're only making 2.5%, you're actually losing money in real terms. So that's the key takeaway here, is that while these things look relatively attractive now with the yields, when you add in inflation, you add in taxes, they're not all they're cracked up to be.
Gotcha. Some really good information there. And so for people that want more information about that, of course, they can come to you all for that.
Yeah, absolutely. They can give us a call. There's a lot of good resources online to explore the different types of money market mutual funds, because some of them invest in government securities. Some of them take a tad bit more risk with some commercial paper and some things that aren't backed up by the full faith and credit. But there's still some great options out there, but it's just important for our viewers to understand where these particular investment options fit in the grand scheme of their financial goals, their portfolio, their particular case facts. So if anyone wants to give us a call and talk about it, we're willing to do so.
All right, appreciate it, Marshall. And of course, you can always get more information by going to our Your Money segments on WAFF.com or watching us here every Tuesday at 4 p.m.